I just want to kick off by asking you about the big news that has come out in the last 24 hours, and that is that of a potential vaccination out of Pfizer that could be rolled out as soon as Christmas or potentially in Q1 of next year. We've seen some big market reactions on the back of that. Certainly, a lot of optimism is being priced into financial markets. But for you, do you think that significantly alters the way you're thinking about 2021 and the opportunities for next year?
Well, it was definitely good news. We've been waiting for some good news for some time now. I think what was surprising was actually the success rate at which these vaccinations have been coming out, and the latest news has been really taken well by the market. But you have to take this with a grain of salt. The disappointing part of the news was that the much lower than expected number of vaccinations that can be produced in a year. And if you look at the rollout that will happen, it's going to take some time till we move we can move to roll this out. In Germany, where I'm currently speaking from our Frankfurt office, there has been a plan on how to roll out vaccination if and when available, even before the vaccination was available. And the news has been that first, the rollout is going to be for the more vulnerable people in order to reduce the toll that the human toll that this pandemic has caused. And the second one would be to people in services, in hospitals. And so this is going to take a long time, if dispensed in that way, till it actually has an impact on economic activity. It will eliminate some tail risks, and some of the human suffering, I think, will be much improved as a result of it. But it's a long haul till we get actually to anything that is close to what people call mass immunity.
It sounds like you're cautiously optimistic there. And the operative word that you mentioned is that of time. It's going to take time. In the interim, do you think policymakers and central banks have done enough to keep companies alive?
Yeah, so if you look at what central banks have done, basically, we've had around 8 trillion of liquidity created through central banks, so roughly 10% of global GDP. We've had another almost 10% of global GDP in terms of fiscal stimulus, and around 5% of global GDP in terms of guarantees that have been dispensed. So a massive policy reaction. And this time around, it was really a concerted action, not just monetary policy being the only game in town, but concerted fiscal, monetary, and guarantee action. And also, I think the speed at which the markets, were benefiting from the intervention was very high. In the week of March 16th, there's been a very bold and broad interaction by the Federal Reserve. They de facto put a floor under the U.S. bond market and under the U.S. corporate credit market. And since then, we've seen a very strong rebound as of May from a very bad development in the first and into the second quarter. We've already recovered half of the distance from the peak before the crisis to the through that we've seen. Now going forward with the second pandemic problems that we're seeing is probably going to slow down growth. In some countries, it might actually lead to a double dip scenario, but we're more optimistic that, this time around the toll will not be as hard. We're learning to cope with the impact of the virus. We're learning to cope with with lockdowns being more targeted. And so going forward, I'm not pessimistic. I mean, eventually we will get through this, but we should not be under illusion that it will happen fast. It will take some time. It'll be at least a year till we go back to pre-crisis levels of GDP. It'll take another year or two till we, are anywhere near getting unemployment and pre-crisis growth paths back. And so it will be quite a long recovery that we're facing.
But equally, one of the things that has come out of the policymakers' response to this pandemic is a huge amount of debt uptake, whether it's from at a company level or at a sovereign level. Do you think that there's eventually going to be a day of reckoning for all of these institutions and sovereigns who've had to take on massive amounts of debt to deal with the pandemic and are really staring in the face of very low economic GDP levels over the next 1, 2, 3, 4 years?
Well, yes. So one of the challenges we're seeing is that, in particular, the situation in the corporate sector, where leverage has been already high and leverage debt positions have already been high pre-crisis, that's where we're seeing many of the insolvencies compound. and concentrated. So as always, how you go into a crisis like this one matters a lot on how you're able to cope with the crisis and how you will actually recover, during the crisis. So there's been 12 years after the financial crisis, there were stretched balance sheets. The corporate sector is much more levered than it was then. This time around, fortunately enough, the banking sector and financial institutions have much less leverage. They're much more solid balance sheets going in. So what we've seen is a pandemic crisis, a health crisis, and an economic crisis, but we haven't seen a financial crisis. And that is partly due to the bold intervention of central banks, but it's also due to the fact that banks were better prepared, more solid balance sheet, less leverage going into the crisis, and that so far has benefited us.